Singapore Airlines just posted a record profit of 2.78 billion Singapore dollars. But here's the catch. A big part of that came from a one-time accounting gain. So the question is SIA really flying high, or are investors boarding a flight that's slowly running out of fuel? With airfares dropping, costs rising, and new competition, SIA's 2025 results may not be as smooth as they look. By the end of this video, you'll know whether Singapore Airlines is still a high-flyer stock or just turbulence in disguise. We'll break this down in three parts. First, what's really driving SIA's record profit? Second, a deep look at its financial health, earnings, cash flow, and debt. And finally, the risks and opportunities ahead, and my final verdict on whether SIA still deserves a seat in your investment portfolio. All right. Let's peel back the layers and see why Singapore Airlines achieved that eye-catching 2.78 billion Singapore dollar net profit in FY 2025. Spoiler, it's not all smooth flying. There are one-offs, plus pressures hidden beneath the headline. First, the biggest boost came from a one-time accounting gain of about 1.1 billion Singapore dollars, thanks to SIA's equity stake in Vistara and Air India merger. By combining Vistara with Air India in late 2024, SIA revalued its investment and booked that gain. That accounting event inflated net profit, but doesn't directly reflect airline operations. Second, underlying operational performance was weaker. Operating profit dropped 37% year-over-year, even though revenue held relatively steady. Why the drop? Because passenger yields, airfares, fell 5.5% amid intense competition and excess capacity in the airline industry. Also, freight/cargo yields fell 7.8%, despite cargo revenue rising 4.4%. More goods moved, but rates were compressed. And of course, rising fuel, labor, maintenance, and operating costs also squeezed margins. Third, strong demand helped. SIA and Scoot carried a record 39.4 million passengers, up 8.1%. The Independent Singapore News. But even with more traffic, margin pressure from lower yields and higher costs dampened the benefits. So to sum up in one sentence, the record 2.78 billion Singapore dollar profit was powered by a big accounting gain, while core airline operations faced real headwinds. Now, let's do a quick intro on Singapore Airlines business overview to understand what keeps this national icon soaring. Singapore Airlines, or SIA, is more than just a flag carrier. It's a global aviation group built on innovation, service excellence, and strategic foresight. Founded in 1972 and based in Singapore, SIA operates one of the world's youngest and most modern fleets, staying true to its mission, providing premium air travel while maximizing value for shareholders and employees. The group runs on a dual-brand strategy, Singapore Airlines serving the premium full-service market and Scoot targeting the low-cost segment. Together, they connect 128 destinations with a combined fleet of 198 aircraft, carrying a record 39.4 million passengers in FY 2024/25, the highest in its history. Beyond Singapore, SIA's multi-hub strategy extends its influence globally. Its 25.1% stake in the Air India group, following the Vistara Air India merger, gives SIA a foothold in one of the world's fastest-growing aviation markets. Strategic partnerships with Garuda Indonesia, All Nippon Airways, and United Airlines further strengthen its network reach. Guided by three core pillars, network connectivity, product leadership, and service excellence, SIA blends human touch with technology. Its cabin crew earned World's Best Cabin Crew 2024 by Skytrax, while more than 80 generative AI projects are enhancing efficiency, revenue, and customer experience across the group. Sustainability is also at the heart of its future. SIA became the first carrier at Changi Airport to use locally produced sustainable aviation fuel and is committed to achieving net zero emissions by 2050. Meanwhile, the SIA Foundation, backed by a 30 million Singapore dollar endowment, supports youth and aviation talent development in Singapore. In short, Singapore Airlines is not just a premium airline, but a strategically diversified aviation leader, balancing luxury, efficiency, and sustainability to stay ahead in an increasingly competitive global sky. Now, let's dive deeper into how Singapore Airlines actually makes its money and where those dollars are coming from. First, looking at the revenue by business segment. Singapore Airlines Group generated a total of 19.54 billion Singapore dollars in FY 2024/25. The passenger services segment remains the heart of the business, contributing about 16.6 billion Singapore dollars, or 85% of total revenue. Cargo operations added around 2 billion Singapore dollars, accounting for 10%, supported by steady freight demand despite lower yields. The remaining 1 billion Singapore dollars, or 5%, came from engineering, training, and retail services like Chris Shop and Pelago. This first chart shows how core passenger travel dominates the business model, while other segments play a stabilizing role during different economic cycles. Next, when we look at revenue by region, Asia remains SIA's largest market, contributing 43%, or roughly 8.4 billion Singapore dollars, thanks to strong travel demand within Southeast and East Asia. Europe follows at 20%, driven by premium routes such as London, Frankfurt, and Paris. The Southwest Pacific region, covering Australia and New Zealand, made up 15%, while the Americas contributed 12%, led by long-haul routes to Los Angeles, San Francisco, and New York. The remaining 10%, or about 2 billion Singapore dollars, came from West Asia and Africa, supported by partnerships with Garuda Indonesia and Air India. This second chart highlights how Singapore Airlines has built a well-balanced global network. No single region dominates, allowing it to weather regional slowdowns. Finally, within the passenger business itself, the third chart breaks down how much revenue each airline contributes. The flagship Singapore Airlines brand accounts for roughly 75% of total passenger revenue, about 12.45 billion Singapore dollars, serving premium international routes. Its low-cost subsidiary Scoot contributes the remaining 25%, or 4.15 billion Singapore dollars, tapping into strong budget travel demand across Asia. Together, both airlines complement each other perfectly, with SIA focusing on luxury and long-haul excellence, while Scoot captures the fast-growing regional travel market. In summary, these three charts show how Singapore Airlines is powered by passenger demand, diversified by region, and balanced by its two-airline strategy, a structure that helps the group remain profitable even in a challenging aviation landscape. If you've made it this far, respect. You clearly love numbers as much as I do. And trust me, these charts don't make themselves. It took me hours of staring at tiny footnotes and annual reports thicker than a durian shell just to bring you this summary. So do me a small favor. Smash that like button, subscribe, and tell me in the comments. Because after reading all annual reports, I think I've earned myself a one-way ticket to a nap. To understand how far Singapore Airlines has come, let's rewind to 2019, before the skies went silent. Back then, revenue stood at 15.9 billion Singapore dollars, a solid number for a premium carrier, but profits were already thin. Then came 2020, and with global travel collapsing, SIA faced its worst crisis in history. Revenue plunged more than 75%, losses widened beyond 4 billion Singapore dollars, and the airline had to raise capital just to stay airborne. Yet, while most carriers struggled to survive, SIA used that downtime to rebuild, modernizing its fleet digital systems and training. By FY 2021/22, signs of recovery appeared, and within just 1 year, the turnaround began. Fast forward to FY 2022/23, and the comeback was nothing short of remarkable. Revenue jumped to 17.8 billion Singapore dollars, operating profit turned positive, and net income surged past 2.1 billion Singapore dollars, the strongest result in its 52-year history at that time. In FY 2023/24, that momentum continued, hitting another record 19 billion Singapore dollars in revenue and 2.7 billion Singapore dollars in profit, driven by pent-up travel demand and disciplined cost control. Then came FY 2024/25, where SIA reported a headline profit of 2.78 billion Singapore dollars, its highest ever. But beneath the headline was a twist. Roughly 1.1 billion Singapore dollars came from a one-off accounting gain through the Air India, the Star merger. Excluding that, core operating profit actually slipped about 37% as competition, fuel prices, and wage costs climbed. Even so, the balance sheet remained strong. Cash holdings above 8 billion Singapore dollars, debt to equity steady at 0.82 times, and return on equity improving to 17.4%. Dividend payouts resumed at 40 cents per share, reflecting management's confidence and commitment to shareholders. From a 4 billion Singapore dollar loss during the pandemic to record profits within 5 years, Singapore Airlines has turned crisis into transformation. It's a story of resilience, reinvention, and strategic execution, one that cements SIA as not just a carrier of passengers, but a symbol of Singapore's ability to rise above turbulence. Let's compare Asia's three leading airlines, Singapore Airlines, Cathay Pacific, and ANA Holdings, using their 2025 results, all in USD. Singapore Airlines earned $14.3 billion in revenue and $2 billion in profit, leading the trio. Its 14.2% net margin and 17.4% ROE reflects strong efficiency and disciplined management, backed by low 0.82 times debt to equity and over $6 billion in cash. With $3.4 billion operating cash flow and $2.1 billion free cash flow, SIA's finances are robust, though its profit was lifted by a one-off gain from the Air India, the Star merger. Cathay Pacific followed closely. $13.4 billion revenue, $1.27 billion profit, and the highest operating margin at 12.6%. Its 17.4% ROE matches SIA's, showing an efficient rebound. However, cash reserves remain thin at $700 million, leverage higher at 0.9 times, and dividends modest at just 6 cents per share. ANA Holdings is the largest by scale. $15.1 billion revenue, $1 billion profit, and strong liquidity of $8.1 billion. Yet with 1.2 times leverage, a 6.8% margin, and slower returns, profitability trails its peers. In summary, SIA leads in profit and balance sheet strength. Cathay excels in efficiency but remains financially cautious. ANA dominates in scale and cash, though its margins lag. 3 airlines, 3 strengths, each flying high in its own way. Now, let's take a look at how Singapore Airlines valuation has evolved from 2019 to 2025, and what those numbers tell us about investor confidence and recovery strength. Back in FY 2019-20, before the pandemic, SIA's market cap stood around 9.3 billion Singapore dollars, trading at just 0.73 times book value. But when COVID hit, valuation multiples collapsed, PE went negative, and enterprise value surged as the airline raised capital to survive. Fast forward to FY 2022-23, and the skies started to clear. Passenger traffic rebounded, earnings turned positive, and SIA's valuation multiples followed suit. PE dropped to 16 times, EV/EBITDA improved to 5 times, and investors began pricing in a full recovery. By FY 2023/24, SIA's market cap climbed past 23 billion Singapore dollars, and PB rose to 1.17 times, signaling renewed investor confidence. And in the latest FY 2024/25 trailing 12 months, the recovery is complete. Market cap has reached roughly 27.5 billion Singapore dollars, enterprise value about 26.5 billion Singapore dollars, and the PE multiple compressed to just 7.6 times, reflecting robust earnings growth. The EV/EBITDA ratio now sits between 3.9 and 4.9 times, the healthiest level in years, meaning investors are paying less for each dollar of cash flow. Meanwhile, price to book at 1.29 times shows SIA is now valued above its asset base, a clear signal of restored market confidence. Finally, while NAV per share eased slightly from 7 Singapore dollars and 86 cents in 2019 to 5 Singapore dollars and 27 cents in 2025, that's mainly due to share dilution from capital raises, not asset erosion. In short, Singapore Airlines has gone from a distressed asset to a premium-valued national champion. The numbers show not just recovery, but resilience, and a leaner, more efficient airline entering its next growth cycle. Here's how Asia's top 3 airlines stack up on valuation. Singapore Airlines leads with a market cap of 27.5 billion Singapore dollars, PE of 7.6 times, and EV/EBITDA around 4 times. Strong cash flow and high efficiency make it the premium pick. Cathay Pacific trades at a PB of 1.17 times and PE of 8.7 times. Pricier relative to profits, but investors are betting on its recovery story. Its EV/EBIT of 8.3 times shows optimism priced in. ANA Holdings is a value play, biggest in scale but cheapest on valuation, with EV/sales just 0.65 times and PE 9.7 times, reflecting slower growth and higher leverage. In short, SIA is the profitability leader, Cathay the comeback story, and ANA the conservative giant. 3 airlines, 3 strategies, each flying in its own lane. Let's break down how these 3 Asian giants, Singapore Airlines, Cathay Pacific, and ANA Holdings, compare in operational performance. First, we look at passenger load factor, or PLF. This tells us how full the planes are. And here, Singapore Airlines takes the crown, filling nearly 89% of its seats, showing outstanding efficiency and demand management. Next is yield per RPK. That's the average revenue earned per passenger kilometer. It measures how much money each traveler brings in per mile flown. ANA leads here, earning the most per kilometer, thanks to Japan's strong domestic network and premium ticket mix. Then we have RASK, or revenue per available seat kilometer. This combines pricing and capacity efficiency. The higher the RASK, the more effectively an airline converts its available seats into revenue. Again, ANA edges out the others, with Cathay Pacific catching up fast as international travel rebounds. So in short, Singapore Airlines wins on efficiency, ANA wins on pricing power, and Cathay is the comeback story with growing momentum. 3 airlines, 3 strategies, all racing to dominate the Asian skies. Singapore Airlines, Cathay Pacific, and ANA, 3 major Asian carriers, show distinct fleet and investment profiles. Singapore Airlines operates one of the world's youngest fleets at about 7.6 years. Cathay Pacific follows at 7.1 years, while ANA's fleet is older at around 11 years. Younger fleets mean lower maintenance and better fuel efficiency. On capital spending, Singapore Airlines plans about $3.2 billion in aircraft investments, including a major A350 retrofit. Cathay spend averages 769 million Hong Kong dollars per aircraft, and ANA is about 23.4 billion Japanese yen per aircraft, all signaling aggressive fleet renewal. In ownership mix, Singapore and ANA each hold roughly 65% owned and 35% leased, while Cathay leads with about 76% owned. Overall, Singapore Airlines leads in youth and modernization, Cathay in ownership strength, and ANA continues heavy investment to modernize its fleet and close the gap. Singapore Airlines stands out with young, efficient fleet averaging just 7.6 years, offering lower fuel and maintenance costs. Its strong $3.2 billion aircraft investment and 1.1 billion Singapore dollars, a 350 retrofit, reflect long-term confidence and modernization. But high capital spending also brings short-term pressure, higher debt, depreciation, and exposure to rising interest rates. About 65% of the fleet is owned, giving asset stability, while the rest lease for flexibility. Yet, that still means recurring lease costs. SIA's global reputation, strong hub at Changi, and cargo strength through Scoot and SIA Cargo remain key advantages. Still, rising competition from Middle Eastern and Indian carriers and potential carbon cost pressures could narrow margins. In short, Singapore Airlines is well positioned for growth and sustainability, but success depends on managing heavy investments and an increasingly competitive sky. So, what's the verdict? Singapore Airlines remains one of Asia's strongest carriers, backed by a young fleet, bold investments, and world-class service. But with rising costs, fierce competition, and heavy capex ahead, investors should watch how efficiently SIA converts growth into long-term profit. If you think Singapore Airlines can keep flying higher, drop your thoughts in the comments. And if you want more deep dives into Asian stocks and insights, hit that like button, subscribe to the channel, and turn on the bell so you never miss a new analysis from Durian Finance.